When I talk about bonds, people usually fall asleep. But really, the purpose of this presentation is that bonds are like stocks. If you recognize when is the appropriate time to buy bonds, you buy bonds for capital appreciation. This presentation is an oversimplification, of course, but just to give you an idea of how bonds fit in your investment strategy using concept related to the business cycles. And of course, you know by now that my name is George Dagnino, and I'm the editor of the Peter Dack Portfolio since 1977. When do you buy bonds? Well, in order to understand what bond prices do, it's important to understand the trend of bond yields. Bond yields follow very closely the growth of the economy. So you can expect bond yields to rise when the economy is very strong, and then eventually decline when the economy topping out, and then declining when the economy is weakening. Here they keep declining, then they stabilize, and then here when the economy grows above potential, they will grow again. If you remember what I said about interest rates and short-term interest rates and bond yields, they follow very much the pattern of all the lagging indicators. What is a bond? A bond is an obligation of the borrower to repay the lender in a given amount of years. In other words, if you invest in a bond, you're really lending the money to a corporation, and the corporation commits itself to repay you over a certain in a given number of years. For instance, a 10-year bond means that the corporation will give you all the money that you lent to the corporation at the end of the 10 years. Also, the borrower will also pay to the lender a fixed coupon every year for the life of the bond. In other words, you lend the money to the company, and the company also commits itself to pay you a fixed amount. This is very important. It's coupon. Let's say $25 every year, okay, or $30 every year. This is attached to the bond. Okay, so when you are committed, when you buy a bond, the borrower will commit itself to repay you in a certain number of years, and on top of that will also give you a coupon every year. What is the yield of a bond? There are several ways of computing the yield of a bond, but to simplify the presentation, let's say the bond yield, the current yield, is obtained divided the coupon by the value of the bond. So let's say the bond value is $1,000, and it gives you a coupon of $25. The current yield of the bond is 2.5%. Now, what drives bond yields? Well, first of all, is the quality of the corporation that issues the bonds. If the corporation is a high quality, let's say the government, clearly is a high quality issuer, so interest rates there are very low. If a corporation is shaky, obviously the lender requires a higher yield to cover for the risk of lending the money to this corporation. The yield also changes with the duration of the bond. In other words, under normal circumstances, the interest or the yield of a bond, let's say 5 years, 10 years, is much less, or is less than the yield of a bond maturing in 30 years. Why? Because it's safer that you will get your money, is sure that you're more confident that you will get your money after 10 years. After 30 years, you don't know. So there is a little higher risks, therefore the lender requires more money. The yield also of the bond depends on the market interest rate. So let's say for that type of corporations, the interest rate is 5% for that quality and that duration, the yield will adjust to that 5%. The last thing that determines the bond yields is the liquidity. If the bond is of low, the corporation has very few bonds, has issued very few bonds, let's say a local, this is something that happened to a client of mine. He bought a bond of a local hospital, and of course there were few bonds, so there was not much liquidity. Therefore the yield of that particular on that particular bonds is much higher than, say, the yield on the government, which is a tremendous market, very, very liquid. So the point of all this is when you look at a bond and you say, geez, there's a yield of, let's say, 10%, this is attractive, be careful, because that 10% relative to, let's say, government 3%, as you recognize, there are many factors affecting bond yields, as I said in a previous slide. But this offers opportunity if you understand what makes bond prices move, and if you understand how bond prices change, you really buy bonds for capital appreciation, certainly not for income. And I am talking about bonds, not single bonds. I strongly recommend either ETFs or bond mutual funds. But you have to learn how to recognize how they invest their money from their yield. The yield of these instruments tell you what kind of bonds is in their portfolio. The purpose of this slide is to give you a sense of why bond prices change and how much they can change. Let's say the interest rates, market interest rates are 2.5%. In other words, if a company A wants to borrow money, they have to pay 2.5% a year. So what does the company has to do to borrow money? They have to issue, let's say, a bond for $100. So you are buying from them, you're lending them $100. So they sell you a $100 bond. And they have to give a coupon that will never change for the life of the bond of $2.5. So every year you will get 2.5, and the bond that is valued is $100 when it was issued. Now let's say because of market conditions, because the business cycle now slows down, the economy slows down, inflation goes down, commodities take a tumble, so interest rates now decline. And let's assume they decline to 2%. So now 2%, so they decline from 2.5% to 2%. Now the $2.5 of coupon stays the same. So in order for what is the price of the bond, so that with the coupon of 2.5%, the yield is equal to 2%, right? So the price has to change because $2.5 stays the same, interest rates have declined, so the bond price has to rise to what? To 125. Why? Because interest rates, 2.5 divided by 125, which is the value, what you're looking at, is equal 2%, the new interest rates. So you can see that you can make money in bonds even when interest rates are very low. If they keep on declining between 2.5% to 2%, you are making a gain of 25%. Because now the price of your bond is valued 125. I know this is fast, but you should study this overhead, because it's very important that you recognize how you can make money in bonds. So the gain is 25% because of the price change. But remember, you still receive the $2.5 that gets compounded. So the point is that the total gain is 25% plus the compounding of the interest that you receive from the corporation. Let's now look at another example, the great bond bull market. Bonds have been the greatest investment since 1982-83. Why? Well, from 1983, that's the peak in long-term interest rates, to 2010, yields dropped from 12.5 to 5%. So the price of the bond had to increase for every $100 had to increase to $250, assuming that the price of the bond was 100 in 1983. Do the computation as I showed you in the previous slide, and you will see that that's the case. Plus, if I may add, you have to add compounding of the interest for 27 years with interest rates 12.5, and then they came down to 12 and then 11. So every year you are compounding, reinvesting interest at 10% for more than 20 years. So you can see why bonds have been the greatest investment in my books since 1983 to 2010. So bonds are for capital gains if you know when to buy and what kind of bonds to buy. When do you buy bonds and when do you sell bonds? The basic idea is that bond yields rise when short-term interest rates rise, and bond yields decline when short-term interest rates decline. I have an excellent, not because I wrote it, but quite frankly, I wrote a great chapter 9 of my book, Profiting in Bull or Bear Markets, that dealing with the bond prices and what to buy and how prices change. That is a great chapter. I like it very much because remember, I managed $3 billion of interest rates derivatives, and I learned interest rates inside and out. So, and everything I knew is condensed in that chapter 9. So I strongly recommend that you read that. But this overhead tells you buy bonds when interest rates decline, when short-term interest rates decline, and buy yields, and sell bonds when interest rates rise. Now, when do interest rates rise? When the economy is strong. When do interest rates decline? When the economy weakens. Please review my previous presentations. And this is a chart that I showed you in a previous presentation, and shows short-term interest rates is the blue line, is the rate on treasury bills, and the red line is bond yields. So when bond yields decline, bond prices rise. When bond yields rise, bond prices decline, and vice versa. So as you can see, the cyclical time is the same. When short-term rates rise, the economy is strong and yields don't do much. When the economy slows down, short-term interest rates decline and bond yields decline as well, and bond prices rise. So it's a way of making capital gains in a very attractive and safe way. Let me recap again when to buy bonds. The business cycle has two important periods. Phase 2 and 3, the economy is very strong in phase 2, slows down in phase 3. We went through the mechanics of why that happens. Then there is phase 4 and phase 1, where the economy grows very slowly. This is from phase 3 to phase 4 is when the economy slows down, and basically what you see is all the lagging indicators declining. You see commodities declining, you see inflation declining, you see short-term interest rates declining, and you also see bond yields declining. These are the times when you want to hold bonds towards the end of phase 3, phase 4, and phase 1. When the economy is strong, interest rates rise, inflation rises, and you don't want to own bonds. Thank you for reviewing this presentation, and hopefully I gave you some ideas on the reasons why investing in bonds is because you can make fairly safe capital gains by investing in bonds during periods of a weakening economy or slow growth economy. I didn't deal with what kind of bonds to buy because it's a very technical aspect, but the important thing is if you feel and you're confident that yields are declining, then the best way is to buy bonds with long durations. If you really know what you're doing, buying high yield bonds is probably an interesting strategy. But as I said, these are issues that I deal with in every issue of the Peter Dack portfolio, which I publish twice a month. And hopefully I convinced you to, I may say so, to subscribe right now. Thank you, and